So let's look at 5.8, 5.13. Question number 5, preparing a company's income statement. The following information has been taken from a book of Hayford Limited at the end of financial year, 31st August 2018. So when you look at the question, it says limited for the company's name, means that you're preparing the income statement for a limited account. So every time that you need to prepare for limited companies, what you need to do is you need to be sure that you take away the financial charges, which is your loan interest, your debenture interest, and put it right at the bottom after you get your operating profit. So as the normal income statement, we start from revenue, which is your sales. So revenue, this amount will be 640,000. 40,000. And then we have to less cost of sales. So you just use your opening inventory. 30,800. Then add your purchases. 250,000. 283,800. And less your closing inventory. 44,900. So I'm just going to put this in a bracket. And then after that, we're going to get our cost of sales. So this amount will be put here, 238,000 to be minus of 238,900. So 640,000 will minus this. So everything here, let's just put it in the middle. 640,000 minus this, we're going to get 401,100. So let me just underline where there is a calculation. Here and here and here. So this is what we call our gross profit. So once you get your gross profit, then you have to less your expenses. So in your expenses, there are a few, which is your business expenses. So the first one, you need to write down business expenses. So it says that there were a prepaid of 1,800, so we need to reduce that amount. So 78,400 minus 1,800, which would be equal to 76,600. Just put this here a little bit. Yes, remove this. So that's one of the expenses. And then there's a provision for depreciation of 80,000. And then the asset is 460,000. So we need to reduce that as well as your director's salary as well. Director's salaries. 2,900, and then we need to calculate the depreciation. So depreciation here, it says depreciation is provided on non-current asset 25% per annum using the reducing balance method. So how do we use that? We're just going to use provision for depreciation of non-current asset. So the calculation will look like this. 25% multiplied by the current net book value would be 460,000 minus 80,000. So this one will amount to 95,000. So in total, the expenses will be 224,500. And then after subtracting this amount, I'm just going to put it right here, 176,600. This amount here is actually called your operating profit, okay, or profit from operations. So profit from operations is 176,600. It has not been your profit for the year. What we need to do is we need to calculate our debenture interest. It's written down at the bottom here, 140,000 in form of 10% debentures some years ago. So your debenture interest should be 10% of 140,000. So it should amount to 14,000 here, and then also it should be in the bracket, 14,000. So 176,000 minus 14,000 should be 162,600. This should be our first step. 160,000 minus 80,000. There we are.